Opening shot, slow zoom into a glowing chart of money supply rising vertically. Eerie, minimalist music, narrator, serious. Measured. What if the greatest transfer of wealth in modern history didn't happen in back-alley deals, or during stock market crashes, or even in the boardrooms of financial giants, but through policies most people believe are designed to protect them? What if the very institutions built to ensure economic stability, the institutions we retold are neutral, scientific, and necessary, have become the most efficient wealth extraction machines ever engineered? And what if this transformation didn't happen with a single decision or a single crisis, but slowly, almost invisibly, over an entire century? Today we're going to unravel one of the most consequential mysteries in economics: how central banks, intentionally or not, evolved into the ultimate engines of upward wealth transfer. A story of good intentions, political pressure, hidden incentives, and a pattern that repeats over and over from 1913 to today. And the most shocking part? You are living inside the final chapter right now. Section 1, Setting the Stage. A system few understand. Before we dive into the origins and the turning points, we need to set the stage. Because central banking isn't just about interest rates, inflation targets, or printing money. It's about power, and it's about control. But most importantly, it's about who benefits when things go right, and who pays when things go wrong. To understand how we got here, we need to go back to a time when the idea of a central bank was already controversial, long before the Federal Reserve, long before modern monetary theory, long before quantitative easing. We need to revisit a world where money itself was in crisis, where panics were common, and where a handful of financiers wielded extraordinary influence. And in that world, a small group of bankers and politicians met in secret, literally on a private island, to design a system that would promise stability, but also quietly embed a structure of incentives that, over the decades, would tilt the economy toward consolidation of wealth. This is where our story begins. Section 2, Origins. The birth of a new power structure, the Jekyll Island meeting. It was 1910. A private train left New York under the cover of night. On board were some of the most influential men in American finance, representatives from J.P. Morgan, Kuhn Loeb, and the U.S. Treasury. Their destination? Jekyll Island, Georgia. Their mission? To redesign the American monetary system in the wake of repeated bank panics. None of them could have predicted how their creation would shape global wealth for the next century. Or perhaps, some of them could. Their goal was straightforward: prevent destructive bank runs, create a lender of last resort, stabilize the financial system. But underneath those goals lay a deeper, unspoken reality. A central bank can never simply be a neutral guardian. It will always sit at the intersection of government power, private banking interests, and public economic well-being. And when those three forces collide, only one group tends to win. 1913, the Federal Reserve Act. In 1913, the Federal Reserve was born. It was not the omnipotent institution we know today. It had limited tools, limited scope, and limited influence. But even from the beginning, one structural issue stood out. The Fed was designed to socialize losses and privatize gains. If a bank failed, the central bank would step in. If a bank profited, the bank kept the profits. This was not done maliciously. It was done because policymakers believed stability was worth the cost. But cost to whom? That question wouldn't be answered until decades later. Section 3, Rise. How policy became power. The Great Depression and the expansion of authority. The Fed's first major test came in 1929, and it failed catastrophically. Banks collapsed. Unemployment soared. Deflation spiraled out of control. Critics argued the Fed didn't do enough. Others said it did too much. But politicians agreed on one thing: the central bank needed more power. And so, throughout the 1930s, Congress expanded the Fed's authority dramatically. By the end of the decade, the central bank had become the most important financial institution in the country. The intent was noble: prevent another depression. The consequence was subtle. The Fed became the mechanism through which government and financial elites could shape the value of money itself. 1944 to 1971, Bretton Woods and the dollar standard after World War II. The world needed a stable financial order. The solution was Bretton Woods, a system that pegged global currencies to the US dollar and the dollar to gold. This gave America immense monetary power, but also created a long-term problem. The US could print dollars, but couldn't print gold. As the country fought wars, expanded programs, and consumed more than it produced, the pressure built. Gold reserves drained. Foreign governments demanded redemption. And in 1971, President Nixon ended convertibility, effectively ending the gold standard. This was the moment everything changed. Now the dollar was backed by nothing but trust, and the central bank, for the first time, had the power to expand money without hard constraints. The age of inflation, and the Fed as savior, the 1970s, brought runaway inflation, gas lines, wage price spirals. The public was furious. The Fed, under Paul Volcker, took drastic action, raising interest rates to levels modern consumers can barely imagine. Volcker's actions stopped inflation. But they also entrenched a new expectation. Whenever the economy falters, the central bank must step in. This expectation would evolve over the next decades until it became a dependency and finally, a vulnerability. Section 4, Breaking Point. When solutions created new problems, 1987, the Fed put is born. After the infamous Black Monday crash, the Fed reassured markets it would provide liquidity and support. Markets heard a different message. We will not let you fail. Thus began what economists now call the Fed put, the idea that central banks will rescue markets from significant losses. On paper, this protects the economy. In practice, it encourages risk-taking and rewards those who are already wealthy enough to take risks. 1990s, 2000s, deregulation meets easy money. As interest rates remained low and financial innovation exploded, banks became bigger, more interconnected, and far more leveraged. Deregulation removed guardrails that once limited risk. Globalization created vast new channels for capital. The Fed's low-rate environment fueled asset bubbles across stocks, real estate, corporate debt derivatives. Each boom created winners, asset owners. Each bust created losers, everyone else. But the most critical turning point came in 2008.